What the government is telling savers around the world and at home is that the U.S. midterm elections, which is to say U.S. politics, are far more important than the sanctity of the dollar. Make no mistake, the economy that we enjoy today is based on fraud. That chart that you show, that hyperbolic chart, always scares me.
Just in the last month alone, gold went from $4,000 to now almost $4,700. Oh, actually, as we're speaking right now, $4,720. Right above $4,700. It's moving faster than I can keep count on Tuesday, August 25th. Bitcoin in the last week and a half alone already moved up more than 30%. And bond yields have, especially on the long end of the curve, come down since the Treasury started intervening in the bond market in various respects. We'll talk about that and the reawakening of gold miners and risk assets with Rick Rule, founder of Rule Media, former CEO of Spot US, and of course the organizer of the Rule Symposium. Great show you hosted earlier this year in July in Boca Raton. Rick, thanks for inviting me. Thanks for coming back to the show.
David, thanks for your participation and support of the show. It's folks like you, but particularly you, that make it work. So I want to thank you for being there. I'm sorry illness interrupted your enjoyment of the conference, but thank you very much for your support of the conference during and before.
It was a great conference, one of my better experiences this year. So congratulations for putting it together. You can check out, by the way, Rick's interview with me at the Rule Symposium, link down below. You can recap Rick's last interview with me and his views then. Back then, sentiment for gold was a lot weaker than it is now. And in fact, one of the themes we discussed during the show is why sentiment at $4,000 or just below $4,000 is so much weaker than the prior year. Despite a good turnout to your conference, I would say the overall market sentiment at the time was rather weak compared to what it is now. And I want to just stress that there has been a reawakening of several asset classes. Precious metals, Bitcoin, tech stocks resurged following the July slump, and gold miners as well. What happened in the last month? There must be a bigger macro story at play, and there must be something that has spooked the government enough to be intervening in the bond market to this extent.
Boy, you've asked me a lot, so let's attempt to get to all of them. I would suggest that the weakening that we saw in the gold price mid-year was a function of higher U.S. interest rates. Simple as that. The higher U.S. interest rate causes the U.S. dollar relative to various asset classes, including other currencies and gold, to rise. Very, very, very simply. It also raises the cost of owning those other asset classes, be it margin debt or anything else, and increases the attractiveness as a savings asset of long-term U.S. securities. When the interest rate at least temporarily peaked, that was difficult. The government looked at the increasing interest rates, and while Warsh himself has described himself as a hawk, high interest rates are inconvenient for the political class for many reasons, not least of which is the refinancing of America's debt. And as you suggest now, two things have happened to spook the market. The first is, and I think this is probably the most important, in effect, counterfeiting. The U.S. government, when they needed to assist the Japanese government in an intervention on behalf of the yen, asked the Japanese government not to sell their holdings of U.S. treasuries. The Japanese had ample money to intervene on their own, but that would have resulted in them adding market pressure to the U.S. Treasury market. So rather than that, the U.S. government counterfeited, that's the right phrase for it, a bunch of new U.S. currencies and loaned that money to the Japanese on extraordinarily advantageous terms so that the Japanese could intervene with counterfeited money rather than U.S. treasuries, which they already owned. The Fed intervention in the short end of the Treasury market has gone on for quite some time. The U.S. government has chosen to borrow from the short end of the market, and while they've been borrowing, at the same time, they've been strengthening the short end by printing or counterfeiting money and buying short-term debt debt that would otherwise be used to satisfy supply. The US government has begun to do something very different now, which is to intervene in the long-term market. You'll remember, David, that in earlier discussions, I talked about the fact that while the Fed would seem to have control of short-term rates, that the market was reasserting control over long-term rates. And the differentiation in yield suggested to me, at least, that the bond vigilantes or the market itself was beginning to control the long rate. So despite the government's attempt to jawbone rates down, that they were rising in effect of their own volition. That suggested to me that private savers looked at the underlying rate of U.S. inflation, which is different than the CPI, and decided that they needed more compensation to tie their money up for longer terms. This is very inconvenient to the government for a whole bunch of reasons, not least of which is the incredible amount of U.S. debt that needs to be refinanced over the 18 months. But the long bond hurts other people who vote, too. 30-year fixed mortgages are up. The cost of consumer debt to fund things like consumer durables is up. The prime rate of interest is up. The high yield or junk market is in disarray. And so the government has been, at least from their own point of view, forced to intervene in the long-term market. What the government is telling savers around the world and at home is that the U.S. midterm elections, which is to say U.S. politics, are far more important than the sanctity of the dollar. And that was all investors needed to hear to bid the gold price up from $4,000 to $4,800.
The gold market, if we were to believe or assume that the gold market moved up on the yield story, then the gold market is telling us that the Treasury is going to succeed in capping the long end of the curve. And if it doesn't believe that, then it wouldn't have moved. Are you on the side of the gold market here?
I don't agree with the thesis. If we observe the gold market going back, I'm embarrassed to say, when I started my career, but before you were born, if nominal yields rise, but the real rates are still negative, which is to say, if rates don't compensate savers for inflation, rates can rise and the gold price can rise. We haven't seen that circumstance in the market since 1981, but I would suggest to you that we're seeing precisely that in the market now. I would suggest that the deterioration in the purchasing power of the US dollar is proceeding along at 8 or 9% per annum compounded, while the long bond has risen to 5.6 or 5.7. At 5.6 or 5.7, you are not making 5.6 or 5.7. You are losing 2.5. The same circumstance that we had in the decade of the 70s. It has been true for 40 years that the bond yield and the gold price have moved inversely, but there is no requirement that that happens in the entirety of the decade of the 70s. The gold price moved in tandem with real after inflation yields rather than nominal published yields.
Before we continue with the video, I'd like to tell you a bit about investing in the mining sector. When you buy a gold miner, you buy their costs with it. The capex, the overruns, the diesel, the labor, the grade misses. Today's sponsor built a business designed to own the gold without owning the problems. Metalla Royalty and Streaming, ticker MTA on the NYSE American and TSX Venture exchanges, holds close to 100 gold, silver, and copper royalties across North America, South America, and Australia. A royalty company doesn't build mines and doesn't operate them. It holds a financial interest in production. So shareholders get leveraged exposure to the metal without the capital costs and without the operating risk. And these aren't lottery tickets. Metalla's royalties sit on assets operated by Agnico Eagle, IM Gold, First Quantum, Kerr, and Nevada Gold Mines, among the largest, best capitalized operators in the industry. They fund the drilling, they fund the mine build, Metalla holds the royalty. Now, here's the part most investors haven't done the work on. Today, roughly 11% of Metalla's portfolio by net present value is in production. By 2030, the company expects that to be 50% or more. That's a massive growth trajectory, a portfolio moving from development into cash flow. So if you want to understand how the royalty model actually works and see the portfolio behind it, the link is in the description down below, or you can scan the QR code here. Start with the corporate presentation and the asset handbook. Do your due diligence today. To answer whether or not what the Treasury is doing currently is necessary, we have to look at the alternative. What if they were to do nothing and not intervene in the Treasury market? What would happen if no intervention were to happen and the free markets were allowed to do their thing? Would rates continue to go up? And the second part of the question, if you believe that the free markets would continue to push rates up, what would happen to the economy?
I think it depends on your point of view. Who constitutes the economy? If you are a saver, you are adequately compensated for your thrift. You are adequately compensated for deferring consumption now in favor of the future. If you are a spender, your spending habits just became more expensive. Almost certainly, in a circumstance where the underlying purchasing power of the currency is declining at 8% compounded, if the market came to control interest rates, the interest rate would rise. It is believed that for a so-called riskless counterparty, and I think given the amount of assets and income that the U.S. government has, particularly its nuclear fleet, that they come as close as you could define a riskless party, particularly because they can counterfeit if they need to. At any rate, it is believed that a riskless counterparty would, in a market, would receive 150 basis points over the real yield. If you assume that the underlying inflation rate is 8%, that would suggest a 30-year Treasury rate of 9.5%, or 150 basis points over the deterioration of the value of the purchasing power. The 30-year fixed mortgage generally trades at a premium to the 30-year Treasury rate. That would suggest a 30-year fixed mortgage rate in the 10.5 range. That would be very, very, very hard on an economy that has come to rely on artificially low interest rates and fraud. Make no mistake, the economy that we enjoy today is based on fraud, based on innovation, based on a whole bunch of things, but importantly, based on fraud. The low cost of capital that the market enjoys today is a consequence of artificially low interest rates and a consequence of savers subsidizing spenders. In a democracy, spenders are much more numerous than savers. Asking spenders whether savers should subsidize them is very much like four coyotes and a lamb having a vote over the lunch menu. Obviously, it's the lamb that's going to get eaten. And the market that we have observed, and if enjoyed is the right phrase, enjoyed for the last 50 years, is very much one where savers have been politically compelled to subsidize spenders.
Question for metals investors, particularly gold investors, is whether or not this environment that you've described is a bullish environment for the metal. Now, let me pull up a chart here. You have told me at the beginning of the year, in January, that you thought gold was overbought, and silver to that by extension was overbought around the start of January, when gold was trading at, let me just pull you up the exact price, pretty much what it is now. On the 20th of January, right before I saw you at the VRIC, gold was trading at just under $5,000. It shot up towards $5,500 in a matter of weeks, a very short amount of time. At the time, you're already starting to think that it was frothy. Should gold retrace or return towards $5,000 again for the second time? Let's assume it happens this year. I'm not saying it will, but let's assume it were to happen again this year. Would you still make the same remark that gold is overbought at $5,000, given that it's happened twice in the year?
It depends, I think, on the causes for the increase. If the U.S. government is successful in driving down the bond yield. And if they continue with the same program of counterfeiting, notice I hate calling it quantitative easing, I prefer to call it what it is, then a higher gold price is absolutely warranted. Understand that the nominal price of gold, the US dollar price of gold, probably varies substantially from where it would be in a circumstance where the denominator, the dollar, existed in the free market. So it really depends on the nature of the buying. What I began to see in December and January of this year was momentum buying in the metal. In the metal, that's what bothered me. That chart that you show, that hyperbolic chart, always scares me. In my life, whenever I see a momentum-driven chart, and I'm beginning to see it in gold now, I get concerned for the very near term. But in real answer to your question, it really depends on the economic circumstance and the policy circumstance involved in the gold price rise. If our government continues to signal to savers like myself that the sanctity of the dollar is of no concern, I'll have no choice but to increase my level of gold savings and decrease my level of dollar savings.
I'm going to overlay the gold chart now with some other things. This is the SMH, the VanEck Semiconductor ETF. That actually has been continuously hammered throughout July and hasn't really recovered much in August. That aside, I'm going to overlay this with Bitcoin, and I'm going to overlay this with the S&P 500, which is a lot more than just semiconductors, as you know. The trend is that, barring a few sectors within the stock market, a lot of risk-on assets have started to reawaken, so to speak. I'm talking about Bitcoin and other sectors within the S&P 500, which is denoted by the orange line here. And they've all started to move around the same time. So Rick, my question is, if the Treasury has to intervene, and presumably these things are moving on the intervention of the Treasury, that to me signals weakness in the economy, because why else would they have to tap their $1 trillion Treasury general account to buy back bonds if everything is going smoothly and all right? Right? I mean, that's a question I ask myself. But yet the market is interpreting this as very good news. A little curious. What do you think?
I wonder, first of all, what really constitutes weakness in the economy.
Yeah.
They say recession is when your neighbor loses his job, and a depression is when you lose your job, which is to say that all definitions are relative to the observer.
Right.
Part of me, in terms of answering this question, can't do it, because I have no opinion as to the real value of the S&P 500. I understand natural resources, I understand conventional financial services, and I don't understand much more. I would say the same thing with regards to Bitcoin and semiconductors. So while what you're saying makes sense, which is to say that the risk-on trades occur as money is becoming easier, and money is probably becoming easier because of political considerations, I can't speak to the price levels and their values because I don't understand those values. And I'll leave it there. I mean, I wish I could answer the question in more fulsome fashion. I'm just not educated enough in the other sectors that you talk about, Bitcoin, technology, or the broad market, to opine.
I think you're being very humble, but regardless, let's move on back to the gold and gold miners sectors here. I'm going to show you now gold and the GDX overlaid with each other. And the question is pretty straightforward. Which do you like more right now? Right now being the 25th of August, gold miners or the gold stocks. And if I were to do a 1 month chart, okay, I don't know why my Y scale is behaving this way, but you can see that the GDX has outperformed gold dramatically since gold started recovering, which makes sense. While I fix my Y-axis, I'll let you explain whether or not you like the miners more or the bullion more.
I think that depends on who you are. But for me, I like the miners more. I'm willing to do the work. I'm willing to understand it. I'm willing to take company risk. And as a consequence of that, the leveraged return on miners that you get as a consequence of rising gold prices, increasing their earnings faster than the increase in the gold price, attracts me. But I think it really depends on who you are. They're very different asset classes, albeit related from my point of view. I save in gold. I regard gold as wealth itself and liquidity. I invest in gold stocks and I speculate in small gold stocks. For me, those
Hmm.
are three different buckets. So when you're asking me the question, you need to ask me the question on behalf of whom? For Rick Rule, somebody who is willing to work hard and has the psychological durability to be a speculator, I probably like the GDXJ.
Yeah.
For investors, people who are willing to take company risk and endure more volatility, they probably like the GDX. For savers, they should like gold.
When you see an environment in which gold is running up 20, 15% in a matter of weeks, and the GDX has moved up from a low of $70 a share to now the 105 in a matter of 3 weeks, do you ask yourself who's been driving this momentum? And if it's mostly speculation, is it time to sell?
The second part of the question, that depends on for whom.
Hmm.
If you are someone like me with between 18 and 20% of their portfolio in gold stocks, this might be a time to sell some. You should note, however, David, that the North American mean market share of precious metals and precious metals equities relative to other savings and investment classes is still less than one half of 1%. Most market participants grievously underown gold and gold securities. So, for a pro or for somebody who loaded up on speculations in a harder part of the market, this may be a time to take some profits. I have a couple of speculative positions that are up in 3 months over 100%. And I have the ability myself to sell half those positions and get the rest for free. Because make no mistake, other than the gold price, nothing much materially changed with those companies.
Hmm.
It is arguable that if nothing has changed in a company and the company stock has gone from $1 to $2, it's precisely half as attractive
Right.
as it was before the price doubled. So I will
Unless
be trimming a couple of my speculative positions, which I added only very recently.
unless we can say that if a stock moves from $1 to $2 in a very short amount of time, and that has prompted the miners in question to raise capital in productive ways and deploy that capital in, again, high ROI productive ways, then you can make the argument that this type of bull rally, albeit the fact that it happened in a very short amount of time, is value adding even in the long term, as it provides the liquidity and capital miners need to return value to shareholders through more drilling or perhaps expansion. Do you agree?
I absolutely would agree with that. I would caution you, however, that at least in the junior space, probably only 10 or 15% of the listings are capable of doing that.
Mm.
The vast majority of them, when they raise money, will spend it on G&A and waste it. So it's very important, taking into account what you just said, that you qualify that with the statement that most of the issuers are less virtuous than those that you describe in your example.
Okay. How long typically does it take for a bull market to work its way into the strategy of a miner for both producers and the juniors? In other words, is this rally long enough to make a difference in the market overall?
Yeah. I mean, most of the promoters that you and I meet, David, are perpetual optimists.
Mm.
And to the extent that they have any reason to smile and add some lift to their story, I would suspect that the time from the moment that they realize the opportunity to the time that they begin to affect that opportunity is measured in seconds. Uh, and I think that capital markets, as they're constructed today, are constructed to serve issuers and generate fees for investment bankers. So I think as soon as the optimism expressed in a market is felt by investors, which is to say, as soon as the hand to wallet reflex is stimulated, that the promoters and the investment bankers they monetized that sentiment very, very, very quickly. You will note, too, that even during the tough times of the market that we experienced this year, uh, the high quality juniors were able to raise money. During periods of time when people were complaining in interviews to me that there was no cash in the system, I was participating in financings and getting cut back, and they weren't offering me any warrants.
Yeah.
So even in the tough times, the so-called tough times this year, for virtuous issuers, times were not so tough. The times are becoming generous for everybody again, and my suspicion is if the market keeps going like this, that October could be a spectacular month indeed for financings.
But going like this in the sense that it will continue to rally, or gold just
Correct.
simply has to stay at the current level?
If it stays at this current level, I think the financing window will be wide open.
Okay.
There's a lot of liquidity on the sidelines.
Do you think there's more skepticism about bull markets overall from investors today than maybe a couple of years ago? In other words, investors need a little more confirmation that this bull market is here to stay before writing out checks to miners.
No, I don't. I think if
Okay.
the markets stay at this level, that there is adequate interest. I point out too that although we have had some generalist participation in this market, November, December, and of last year and January of this year being examples, there is still very, very little generalist participation in this market. If you start to see generalist participation in this market, which is to say, if participation broadens, uh, then, and I'm not saying it's going to happen, but if it does happen, uh, then you'll see the market get underway in earnest. It has been my experience, by the way, that one of the best indicators of generalist participation in precious metals markets is when the silver price begins to outpace the gold price.
Yes.
I have noticed over 40 years, and I don't know why this is, perhaps it's the lower unit price of silver, but when the gold price has moved enough that the precious metals narrative is justified for generalists, and they come into the space, that silver begins to outpace gold. Whenever I begin to see silver substantially outpace gold, I get concerned about overly broad participation in the market.
All right, I'm going to show you one more chart. I know the visuals are a little bit messy. Please bear with me. I've overlaid gold with a few other things in the metals complex here, along with oil. So WTI here is a bar chart. Platinum, silver, gold is the orange line, and I have here also silver as well. Have any of these things moved in a way that surprised you this year? If I were to, let's say, go back in time and talk to Rick Rule in December 2025, and I asked Rule to give an outline or a prediction on how things would move. And if I were to tell you at the time, let's say I were to tell you at the time the U.S. and Israel would attack Iran and the Strait of Hormuz would be closed, and make a prediction of how markets would react. Fast forward to August 2026 rather, have any of these things surprised you?
Well, certainly in view of the way you asked the question, including the Straits of Hormuz, I would be surprised the oil price was this low. I think I think the market underestimated the amount of floating inventory that existed and the amount of inventory that existed in strategic and economic stockpiles. The fact that while the supply disruptions haven't been total, and while we haven't had supply disruptions in North America at all, the fact that the interruption of energy molecules through the Straits of Hormuz has only impacted the oil market to the extent it has is a surprise. I think a second surprise to me is that the impact of higher oil prices, although they're less muted than I expected they would be, should have been felt more in the broad economy. Higher oil prices work in effect as a tax, although They don't necessarily go to governments. And I would have expected more economic weakness as a consequence of higher energy prices than has occurred.
Mm-hmm.
The fact, and by the way, I've made mistakes in a couple interviews that you and I have done this year, David, where I said that I expected the increase in the copper price to be moderated by what I saw as a weakening economy. That hasn't happened. I was just dead wrong. I know I'm jumping all over the page, but that's in response to the inputs on this graph, which are numerous.
Yeah, that's right. And can you just explain why silver, platinum, palladium, which is the purple line here, platinum is the turquoise line, silver being the green, and gold being the blue, move together? I can understand silver and gold. Why platinum and palladium, especially this year?
I think that platinum and palladium may again be added to, in investors' minds, the precious metals complex. I often think of platinum and palladium in an investment context as being related to the auto catalyst market. But it's important to note in a lot of cultures, particularly East Asian cultures, that the platinum group metals have traditionally been regarded as precious metals. And I note that when precious metals run, the influxes of capital into things like the Sprott Physical Platinum and Palladium Trust increase. So it could be that in the minds of a subset of investors, platinum and palladium are being reintroduced into the precious metals matrix. I don't know enough about that to comment. I haven't studied the platinum market other than the supply side of the platinum market since I left Sprott.
And on copper, you mentioned copper somewhat surprised you. Let me pull up another chart. I've heard the opinion that copper has been moving as basically a puppet to the AI build-out story. Those were the words that I've heard from some other analysts and economists. If you overlay the copper price, which I've done here, admittedly that's not really the right unit for copper, but the price movement still remain consistent. But anyway, copper and the S&P move together, and this relationship is stronger than copper versus gold if you were to chart both of them together. Is copper really just a play on the AI story now?
I don't believe that.
No. Okay.
There are physical costs to holding copper. Copper is an industrial material, and though it's forward-looking, it's not thinking that far in the future. Higher interest rates should penalize copper because holding copper in inventory on commodity traders' books is very interest rate sensitive. Very often, those traders are using 90% margin. One would expect higher nominal interest rates to adversely affect the willingness of traders to maintain copper inventories, and it's extremely economically sensitive. The build out of data centers and the build out of electrical facilities necessary to power those generators is a 2-year forward or 3-year forward or 5-year forward phenomenon. The copper quote is weekly. Mm-hmm. If we were experiencing the decline, as an example, in consumer durable purchases, white goods and automobiles, that I would have expected to happen in 2026, you would have experienced real-time decline in copper demand, not decline in forecasted demand. Yeah. I suspect that the investment case around the copper miners, the ability to produce marketable amounts of copper 3 years from now, 4 years from now, 5 years from now, is very much impacted by the forecasted demand from AI center build-outs. In other words, I think the narrative is very, very similar. I think the reality with copper, though, is that the economy, the underlying economy around the world is substantially stronger than I thought it would be. In a time of war, in a time of higher interest rates, in a time of threatened trade wars. I'm at a loss to explain the economic strength that we're enjoying, and I'm at a loss to explain how the government can conjure this as a bad economy, one that needs lower interest rates.
On the lower interest rates front, what is your expectation for the yield curve? I know you run Battle Bank, and financials are dependent partly on the direction of the yield curve for profitability. In theory, if the yield curve flattens, net profit margins for banks, all else being equal, should be lower because banks typically borrow on the short end of the curve and lend on the long end. And so any changes to your operations? Yeah, please.
What you say describes the banking industry as a whole,
Okay.
which is why I've always been able to outcompete the banking industry. The idea that I'm going to play chicken with interest rates, particularly with a 10% equity slice, is wrong.
Okay.
At Battle Bank, we borrow at a variable rate and we lend at a variable rate. The idea that I'm going to repeat the failings of the U.S. savings and loan industry or Silicon Valley Bank or Republic Bank, Republic National, I'm sorry, and lend long-term at fixed rates and borrow short-term at floating rates and expose myself to an interest rate rise is something that's absolutely positively not going to happen. I've been in the banking business for 50 years now, and I'm tolerant of small mistakes. I have no tolerance whatsoever, not a shred of tolerance for big avoidable mistakes.
So can you just describe in layman terms how what you've just said mechanically is different from a traditional big bank, borrowing and lending at variable rates instead of fixed?
The bankers look at the yield curve that you described, the fact that
Yes.
short-term rates are low and long-term rates are high, and they seek to arbitrage those two rates. They seek to borrow money from their depositors at 3 and lend that money out to the borrowers at 8 or 8.5 against collateral that has traditionally been stable, like 30-year fixed mortgages, as an example. The banks will even lend at 6.75 or 7 because the historic default rates have been low. The difficulty, particularly in things like a 6.75 rate 30-year loan, is if the interest rate rises, you're funding that 30-year fixed loan with overnight deposits that you have that you're paying 3.75 or 4 on. If all of a sudden you aren't paying 3.75, you're paying 6 or 7. That loan, after your G&A, and particularly with loan losses, goes away. Battle Bank will absolutely positively make you a 30-year fixed rate loan. And as soon as you've made 3 payments on that loan, as soon as the loan is considered to be performing, we will sell it to somebody who wants to own 30-year fixed 6.5% paper, an insurance company or a big bank that believes their funding source is secure enough. That is nothing, borrowing short and lending long, that me or my shareholders want to engage in.
So bottom line is you've managed to make a system that allows your margins to stay relatively consistent regardless of where the yield curve goes. Is that correct?
That's correct. We punish near-term earnings in favor of long-term solvency.
Okay. Final question. Of all the assets and commodities that we've discussed today, would there be anything that you're currently adding your position to?
I am adding to my position physical gold
Right
because
now.
that's what I do. As an example, I just came off a very successful conference. Put in layman terms, that means the conference made a lot of money. Some of that money I'm going to save. And most of what I save, I'll save in gold. And I'm fairly price insensitive. Would I have preferred to buy it at $4,000? Yes. Will I buy it at $4,700? Yes.
Okay. So you don't dollar cost average your gold holdings. You just buy whenever
there are some circumstances like
right.
December and January this year where there was a hyperbolic upchart in gold.
Yeah.
I said, you know what? I got to hold off. I don't want to participate in this. In fact, as you know, I sold 80% of my physical silver. But mostly, I'm a systematic saver. I've been a systematic saver since I was 16 years of age. And I save in whatever asset class at the time feels most advantageous to me. It might be, as an example, when the amount of economic surplus generated by the conference is actually very clear to me. It may be at that point in time that I over allocate to short term US Treasuries for eventual redeployment in gold. That really will depend on the amount of liquidity available to me and the relative attractiveness of various assets. My hope is that there will be investment classes which are attractive enough to me that I move money from my savings to the investment account, which is to say, I hope there are asset classes that become cheap enough that I'm willing to have less held as savings, less held as liquidity, and more invested directly.
Did you ever buy back your silver positions,
No,
by the way, that you sold? No?
I have not. Silver occupied a speculative part of my account, and I bought silver because it was hated. I bought most of it below $20.
Yeah.
Silver, as you know, ceased to be hated. And when the reason that you own something goes away, I believe that you need to at least reconsider your investment thesis. And in January, when I sold my silver, I needed to decide whether it was still the most attractive harbor for speculative capital or not. When I decided it wasn't, I sold it and I put it in buckets that I considered to be more appropriate at the time.
Yeah. I remember we talked about that. Well, silver at $68. I would argue, and please correct me if you've seen other contradicting evidence, but I would argue that silver and gold throughout the summer have become hated again. This was before the run-up that we saw in now August. Right around the time of this Rural Symposium, going back to what I talked about earlier in the introduction, the sentiment was very gloomy, especially around miners. That's because the prices of silver and gold and the miners have been coming down all year, despite the fact that if you look at the one-year trend, it was still up since a year ago, and it was still up considerably since 2 years ago. I guess people are short-term focused. Anyway, the point is, silver is still much lower than its all-time highs earlier in the year. Do you think it's still hated today?
I don't think it's hated. I don't think it was hated. If you dial yourself back 5 years or 6 years, the comments that would have accompanied this interview online would have been overwhelmingly negative.
Okay.
The silver market's dead. It'll always be dead. People who participated in the silver squeeze, which didn't squeeze, they weren't bored by silver. They despised silver. They regarded silver as a jilted lover. Probably 15 of 20 social media comments were anti-silver. People are bored of silver right now. Some silver holders are afraid of silver. But to describe it as hated, I would suggest more it's less loved.
And my final question today before we close off, you save in many things, including gold. I wonder why silver isn't a savings vehicle for you, given that, well, you said silver is a speculative investment for you. But if you take a look at this chart, for example, yes, silver and gold tend to move together, but over the long term, one can make the argument that silver has had similar savings properties as gold if you look at it from a 40 to 50-year time horizon.
I agree. And I think partly it's a bad habit formed of age.
Okay.
I came to regard in the 70s gold as a mechanism for maintaining my purchasing power and silver as more of a trading vehicle. If you look back at the outperformance of silver to gold in the decade of the 70s, you'll see that although both of them outperformed almost every other asset class on the planet, that the price rise in silver from, if my memory serves me well, sort of $1.50 in 1970 to 50 in 1981. That's just an astonishing move.
Yeah.
Most of it without me, by the way. I have to say. They exceeded every level of greed I had, even as a young man,
Hmm.
relatively early in that trade. But the lesson wasn't lost on me. Uh, I I had a sense when I began to save systematically in gold, which was in the year 2000,
Right.
that there would be times when silver would outperform it. But in terms of my own psychology, that silver was a more speculative asset class and gold was more of a savings asset. The chart that you just showed me that over my lifetime, I'm probably wrong.
Mm. Well, hindsight, so it's 2020. You could have also bought Nvidia stock, and one could have argued that it was a savings vehicle in itself. Rick, thank you so much for your time today. I really appreciate any. Do you ever look back at just in the last year? And I know everybody has regrets over their investing life, but just in the last year, were there any regrets in moves that you've made or perhaps didn't make?
I don't think so. I'm pretty tolerant of my own mistakes now, having made a lot of them.
Hmm.
Um, Perhaps I spent too long in my buy the best trade. You'll recall that a couple of years ago in our interviews, I said that for most people, if they bought Franco, Wheaton, and Agnico and spent the time that they would have studying the juniors with their children or grandchildren or gardening,
Yeah.
that they'd be ahead. I also said that those people who were willing to work and take risk would do better coming down the value chain. I am one of those who was willing to work. And I probably should have shifted my focus down market to the speculations sooner than I did. But the truth is, if your greatest sin is making a little less money than you otherwise could have, that's not as great a sin as losing money. So on balance, I'm not unsatisfied with what I did. I mean, a minor criticism of myself. I know
Hmm.
a lot about the community banking business, and the community banking sector in the United States is cheap, really cheap, and it will continue to consolidate as older owners die and
Hmm.
sell their institutions to bigger institutions. Uh, there are a number of community banks in the U.S. with great franchises, small banks that are selling at substantial discounts to book value that earn 10% after tax on book, which is to say, there are numerous opportunities in the United States to buy companies based on your purchase with a 15% after tax earnings yield that are able to reinvest that after tax earnings yield to grow. And probably I should go back to work in my roots and allocate more of my money to a sector that's very attractively priced that I know about. I've been having more fun, however, with rural media and the rural classroom. And they've used up enough of my time that most of my activity in banking is confined to building my own bank, Battle Bank.
Okay. Well, if we'd like to follow you, reach out to you and read more of your work, where do we go?
Well, the easiest way to reach me is ruralinvestmentmedia.com. Go to that website, list your natural resource stocks, and I will, for free, rank those stocks 1 to 10, 1 being best, 10 being worst. Please, by the way, no crypto, no pot stocks, no tech stocks. Leave an old guy to do what he does well. A little bit deeper relationship, but still free, can be found at the Rural Classroom. 26,000 people now enjoy hundreds of hours of free programming, free Thursday questions and answer sessions with myself. That's ruralclassroom.com.
Hmm.
Uh, More detailed, the investment conference, the Rural Natural Resources Investment Symposium, which you just attended, has the recordings on sale. We've sold over 300 copies of the recordings for those people who couldn't be there themselves. Ruralclassroom.com. If you buy the recording, just like if you bought a live seat, and you're uncomfortable with the value proposition, we have an ironclad money back guarantee. If you buy the recordings, listen to them, and don't think you got your money's worth, email me. I'll give you your money back. ruleclassroom.com. Finally, if for any reason whatsoever your listeners are unsatisfied with their relationship with their current bank, maybe as an example, they don't get paid interest on their checking accounts, or maybe the bank won't lend them money secured by their physical gold and silver, or maybe they want to save in some currency outside the US dollar or the Canadian dollar, they should check out Battle Bank. We'll do all those things for you. We'll pay you interest on your checking account. We'll allow you to save in 20 currencies. We will allow you to set up a credit line secured by your gold and silver. If your bank won't, try battlebank.com.
Okay, we'll put the links down below, so please do make sure to follow Rick and his work there. Thank you, Rick. Appreciate your time as always. We'll see you next time.
Thank you. Thanks for the opportunity, and thanks again for your support of the conference.
Yes, and thank you for inviting me. Good to have you on the show again following the conference. Thank you for watching. Please do like and subscribe, and follow Rick. Links down below.